Welcome, and thank you for
Morning.
joining us
Thank you.
today. It's great. We're at the opening act. We have a
Well,
lot to
when
talk.
Tim describes somebody as bright, I mean, there's only one way, and it's down. So let's see if I can prove him otherwise in a conversation.
Absolutely. Let's start with trends in the industry. You recently released some results. How do you see the U.S. banking sector going?
We do a quarterly banking profile survey of our banks based on the call report data, and they're doing exceptionally well. They have turned record profits. They're well capitalized. The number of troubled banks list has shrunk. Things are exceptionally good, and I'm telling my staff not to get used to it. We have not had a single bank fail in 14 months, 15 months now.
That's a long time.
And
Yeah.
it's been a long time, and this is not necessarily a new normal. I'm telling them this is the new abnormal, and we need to prepare for a normal cycle where some banks do fail. In a free market economy, that's what happens.
So are there any headwinds, anything that worries you in terms of the economic landscape?
We'll look for concentrations in the portfolios. We'll
Right.
look for, United States is a large country, and there are regional differences in the economies as well. And so we just focus on making sure that, our ag sector is doing well, that the commercial real estate is doing well. What's the exposure for these banks? We look at the indirect exposure that these banks have to leverage loans, et cetera.
Consolidation trends. You oversee close to 5,000 banks. Do you see the sector shrinking, consolidation taking place?
It's been shrinking for a long time,
Yeah.
and it's I don't want to say it's inevitable, but it's just how it is. Market forces are working in such a way that the economies of scale don't work to the advantage of a lot of these smaller
Right,
institutions.
right.
You're asking them to invest in technology and cybersecurity at a very large cost to them, and their regulatory and compliance costs are large. They're trying to expand their customer base, and they're competing with much bigger players who can spread the cost over more accounts and more customers. So it's not surprising that there's consolidation.
Yeah, so we'll get back to digital issues, but the technological investment and the cybersecurity, et cetera, are probably driving a lot of these consolidation
It is.
trends. Yeah.
It is.
Yeah. Here in the audience, there are a lot of people coming from different parts of the world. Many visiting because of the IMF World Bank meetings. One question in their minds is, where are the US agencies going with regulatory efforts here? Can it be described as deregulation? How would you describe what's going on in terms of regulatory policy here in the US?
I personally don't take a view it's deregulation. I believe that we had the post-crisis response on the regulatory side that had a more uniform approach for banks, and it was a reaction that we had to the crisis itself. Right. And I think it's now 10 years out. We have an ability to take a look and see if we need to calibrate and tailor those regulations to the risk profile and the business model of different institutions instead of just having a blunt cutoff. Right. And that's what we're doing. So if folks are describing that as deregulation, it's up to them. I don't view as it. I didn't take this job as we're going to deregulate. You don't want to be the regulator who lost safety and soundness.
Absolutely.
Or
Absolutely.
consumer protection.
Yeah.
and other
Yeah.
regulations.
And the way we see it is this is happening all across the world. I mean, regulators are looking at everything that has been done in the last 10 years.
Or more so, yes.
Right.
In some cases.
Assessing effectiveness,
Yep.
Intended and unintended consequences, all that work in evaluating the agenda and perfectioning what's been in place.
You have to. And frankly, if you take a look at the regulations in general, it's a long time ago when I was at the Federal Reserve, I had a good boss, and he basically taught me that regulations are like a balloon. You squeeze something here, it comes out there. And before
Absolutely.
you squeeze it, you better know where it's going to come out.
Yeah.
So quite often you actually end up with unintended consequences, and it's healthy for regulators to be willing to recalibrate and rethink every few years.
Also, a number of reps from foreign banks that operate here in the US. This week, there are recent proposals on tailoring regulation for those foreign participants. Can you tell us a little bit about how do you see those proposals and where do you think they're heading?
Sure. So the FDIC has not voted on those proposals yet. Just like we do for U.S. banks, we need to take a look at the foreign banks in the United States and understand whether the protocols and the regimes we put in place post-crisis are appropriate for the work and the market concentrations and everything else they're doing in the United States. And I think we're getting to a good place.
Congress passed 2155. Now the agencies are focused on implementation. FDIC work on implementation, a lot of proposals. What are the key issues there?
No hiccups, really. I mean, Congress gives us a mandate, and I always say, you know, my job as a head of a regulatory agency is not to regulate based on my personal beliefs or what I like or don't like. We take regulations, legislation as it comes, and we promulgate regulations based on congressional intent. And so we are hard at work to make sure S21 becomes reality on the ground, and we have a number of proposals out to implement S2155.
Tim, in his initial remarks, talked about the process of different countries implementing global standards. There is the risk of countries going in different directions, not necessarily everyone implementing global standards in the same way. That may cause fragmentation, but there is intense regulatory legislative activity at the local level. How do you see coordination, harmonization, developing a global framework for regulation?
So I cannot even tell you how many working groups we have with different organizations.
Right.
We have
See
staff
at the Basel Committee.
Correct, at Basel Committee, at the FSB, at IOSCO, at IATI, at SRB, at you name the acronym. We
the
pretty
whole
much
alphabet acronyms,
have
yeah.
a working group to make sure that coordination happens, because in the end, the global system is not. You know, you have these banks that are operating on a global scale and operating in 50, 100 countries.
Right.
And we need to be cognizant of the footprint they have and how the regulatory regime is looking at those institutions in each country. And you want to make sure that, should we have a resolution of any kind, that you can actually appropriately address that in the countries where they function. And for that, you need harmonization and regulatory coordination.
Well, and this is what's been going on for the last 10 years, everyone working sort of off the same playbook. Resolution. It's right in your alley. The FDIC has done tremendous amount of work coordinating with foreign counterparts. I remember a few years down that first meeting with the Bank of England. Europe had set up its own resolution authority, the SRB. You're constantly in touch. I even believe this week there are further meetings. How is that process going in terms of developing a framework that is effective and get us ready for the unfortunate event of maybe the failure of a large systemic bank? It's everything in place. How is coordination, cooperation being set up?
I would say coordination is very healthy. We are very much so engaged at both the principal level and the staff level. It's something that I think about quite often. You know, FDIC has a long history of resolving small banks. And as much as, you know, it's never fun, it's never optimal, we're very good at it. When it comes to resolution of a large bank, you know, it would have more seismic effect on the rest of the world. So you have to coordinate. So
Right.
we constantly have trilateral, bilateral exercises. We have tabletop exercises. We talk about things. We look at what kind of protocols have we put in place. We look at the how different jurisdictions handle resolution and how would we coordinate with those jurisdictions. And I would say it's a lot of progress has been made in that area, and we'll continue to make progress.
Often there is a discussion about allocation of resources. When you think of a global bank that has significant presence in different jurisdictions, the natural desire from national regulators to have enough resources in their jurisdiction. That can lead you to ring fencing in some cases, or at least putting barriers to capital and liquidity, responding to the very natural desire to protect the local stability of the system. How is that coordination taking place? How do you think we can get to a place where there is an effective coordination and understanding and trust among regulators on a cross-border basis?
It has to be based on trust. And frankly, because the natural inclination would be that you want to protect your jurisdiction.
Right.
That's just how it is. So we have done a lot of work on making sure that ring fencing is, if not eliminated, minimized. Because you know, the system has to have agility. And if you have agility and you're able to distribute capital and liquidity in the way that's optimal for the entity so that the entity doesn't fail, that's exactly the scenario that you want to have. You don't want to have a scenario where everybody's ring fencing and all of a sudden nobody's willing to give an inch. And because of that, we have an institution fail. So you need agility, you need flexibility, and for that you can't have ring fencing.
Well, we said we were going to talk about technology and digitalization of the industry. How do you see that trend does it mean for regulators, especially from the perspective of new entrants, some of them never been regulated as financial institutions, some of them very large, and some of them leveraging the power of data. It's our regulatory framework, the regulatory perimeter, sufficiently defined that allows us to deal with new entrants and potential risks that might
So it's,
bring?
as you can imagine, and I would suspect in your host countries, and I'm sorry, home countries, it's the same case. Regulators are not very agile when it comes to technology, right? I mean, we are risk averse by nature of the job we do. So our regulatory framework is not always flexible enough to allow new entrants into the marketplace unless they look exactly like the prior entrant. So now we have digital technological changes, revolutions really happening, not because it's new, and people talk about fintechs and kind of this financial technology as something new. Fintechs are not new. Financial technological developments have been happening in banking since, I like to say, the Medicis, set up the first bank as we know it today. But what's new is that they are moving at such rapid pace and on such a scale that we have never seen this before. And so the regulatory framework is lagging behind to be able to be responsive to that. And the initial reaction you would have on a regulatory side would be, don't do it, right? But we can't do that. We need to be able to move forward as regulators and understand what's happening. So last week I was in California and I met with 20 or so fintechs, companies that are in the consumer lending space. They're basically doing the job of lending that banks used to do. They're just doing it in a different way. And I ask why, how did you come up with this idea? How did you even think that this is a viable business model for you? And where do you see the regulatory obstacles? Where do you see the impediment for you teaming up with banks? Or where do you see the impediments for your business model moving forward on the regulatory side? And I have to tell you, it was eye-opening. I joke that I used to know technology when I was 20 years ago programming in COBOL and Fortran and Pascal, and those people just looked at me and laughed.
Now we need to learn Python and similar.
Oh, it's so far advanced that we have catching up to do.
Yeah. Well, you're doing that precisely at the FDIC. Tell us about the lab you're setting up.
So we're creating an FDI lab, Office of Innovation. I realized when I came to the FDIC that if we're unable to internally understand and cooperate with these banks and non-banks to understand exactly what they're doing on the technological side and how is this new frontier being defined and managed, we won't be able to understand where is systemic risk. We won't be able to understand where some of the potholes lie until something happens, and then we'll be in the putting out fires mode. So setting up the Office of Innovation to basically deal with those issues, hiring somebody from the outside to head the office, so we have kind of the non-regulatory head-on as we think about it. I'm looking for somebody who knows technology more so than regulation, and then the office will be staffed with a number of regulators from the agency. But the purpose of it is to have an ability at the agency to learn and to kind of foresee where some of the regulatory obstacles are, and to foresee what regulations need to be put in place to kind of look at this new frontier. We can't just say it's different and therefore we don't want to deal with it. It's going to happen. And instead of fixing things after they break, I would like to move forward by creating a framework where things don't have to break.
And in this space, regulatory certainty, it's quite important about thinking, deploying technology, but knowing, am I doing it within the confines of regulation? So I guess this lab will allow you to test some of those ideas, get grips with the issues?
Yes, that's the goal. What I've learned is that when I was in private sector, that the worst thing you can do to a business is provide uncertainty. If there is uncertainty, especially regulatory uncertainty, businesses won't do things. They will just not do it. There's no incentive for them to do things because the penalty on the other side could be exponential. And it's not just a financial penalty, it's a regulatory penalty, it's a reputational penalty. So you want to create an environment where you provide more certainty without being too prescriptive, because you want to allow entrepreneurship and you want to allow innovation and you want to allow all of that, but you do need to give folks at least a roadmap, if not the rules of the road.
And I would imagine that also requires an international, global perspective. I mean, these developments are happening on a global basis. Many of these firms operate precisely.
Absolutely. Absolutely. I think if we only look at the United States, we're going to be shortchanging ourselves in the long term.
We promised the audience to allow a few questions.
Only if they're good
Many are coming. Yeah. Title II of Dodd-Frank.
Yes.
When Treasury was doing its review of the regulatory landscape, this was one of the topics they were looking at. Do we need to change anything? Do we need to reform? Do we need to rely more on bankruptcy? This straight from the audience.
So, who asked that question? I will find you. No, I'm kidding.
Raise your hand.
Title II is the law of the land. And I tell folks, whether you like it or not, Dodd-Frank is the law of the land. And Title II is set up in such a way that it gives us a tool that if we don't think a firm can go through bankruptcy without a systemic disruption, if we don't think we have other tools to resolve this firm and deal with financial stability issues, we have an option to go through Title II orderly liquidation. And it's something that I think of very seriously, and I wouldn't. I'm hoping that during my tenure I won't have to pick up the phone and ask for the order liquidation fund to be deployed. But it's something that we have as a tool, and it's here to stay. And we're making sure that if you're going to have this tool, that this tool is as viable, efficient, and real as possible. And that's what we're working on.
On the resolution space, as we just mentioned, the US, UK, and EU resolution exercises are going to be hosted by the FDIC this week. What can you tell the audience about that exercise?
Fun. No, I'm kidding. These things are never fun, but they're useful. We basically get together and we have a principal level meeting where we sit around the table and we think through resolution issues. And speaking exactly of the issues you brought up, ring fencing and how do you respond to the other jurisdictions' desire to protect themselves. We put everything on the table, and it's an honest exercise, and it's both intellectually honest. It's kind of a trust-building exercise as well. And I think if you can sit across the table with folks who will be in charge of resolving a large entity, should we come to that point, it's a viable tool for us to kind of think through issues, but also build the communication channels and the level of trust before we ever come to that position. Right.
Well, we did run out of time, but I have one last tough question for you. I heard about your tour of the U.S., visiting every single state and being in touch with banks and customers in every place. How is that going?
So I like how he said tour. Tour would imply it's something fun. It's a useful mechanism for me to understand how are we regulating. And also, United States, as I mentioned, is such a huge country. And I've driven across I-10 and I-5, and I've covered a lot of the United States by car. And it's only when you get in the car and you drive across that you realize the regional differences, the geographic and socioeconomic differences. And I lived in the Midwest for a short time in my life, and I realized it's very different than the coast. So I committed to a nationwide listening tour where I would go to every state, meet with the regulated entities, meet with some of the consumers and customers that they serve, and meet with the state commissioners and see how are we regulating, how is the economy doing, and just get a sense from the ground how things are. And so by the end of the summer, by August, I think we'll have covered 22, 23 states.
Well, I'll tell you what, we'll invite you next year. You can tell us about the entire 50 states.
Well, I may die if I do 50 states in that short period of time. But no, the point is exactly that. We shouldn't have our regulators expect that the regulated entities will always come to us in Washington to be heard. We need to go and actually get the feedback from the ground and bring it back to DC and understand we can't be regulating from the Beltway here in Washington. So that's exactly what I'm trying to accomplish.
Jelena, thank you so much for joining us. This has been a great start for this conference. Thank you.
Thank you very much. Good luck.
Thanks, everyone.
Thank you.